Welcome to XYPN Radio, where your host Alan Moore brings you into a community of fee-only financial planners who want to profitably and successfully serve Gen X and Gen Y clients. If you're ready to get the knowledge you need from leaders in your field, learn from forward-thinking advisors, and take action on your own goals, XYPN Radio is the show for you. Here's your host.
Hello and welcome to this episode of XYPN Radio. I'm your host, Alan Moore, and I'm excited to have XYPN member Grant Bledsoe, founder of Three Oaks Capital Management, on the show today. Grant started his career on the institutional trading side of Schwab before eventually deciding to launch his own RIA. With no financial planning experience, he didn't grow as fast as he hoped at first, so he went and got his CFP and has been growing rapidly since. He's now at $250,000 in recurring revenue and has hired his first part-time team member, which he hopes to scale to full-time soon. We had a really interesting conversation about how he has had success with a pretty low-cost digital advertising strategy, which targets people who have visited his website and then invites them to a monthly webinar, which then converts them into clients. We also talked about how he moved his firm from Oregon to California and how he managed to keep all of his clients through that process. We also spent some time talking about the future for his business and his plans, with his goal being to grow to a much larger firm and some of the barriers he sees for that growth goal. XYPN Live is a financial planning conference unlike any other in the industry. At XYPN Live, you'll learn real strategies for building your firm, whether you're just getting started or you're a seasoned firm owner. Or maybe you just want to earn some CE credits, connect with other advisors, or be part of the real financial planning movement. XYPN Live offers all of that and so much more. Go to xyplanningnetwork.com/XYPN Live Radio to get your pass today. You can find any of the additional resources that we mentioned during the episode at xyplanningnetwork.com/211. Also, be sure to go to xyplanningnetwork.com/VIP to join our private group just for XYPN Radio listeners. It's the community of advisors we've all been looking for that's there to provide support when we need it the most. Best of all, it's free. I encourage you to check it out. Again, that's xyplanningnetwork.com/VIP. Without further ado, here is my interview with Grant. Hey, Grant, welcome to the show, man. Thanks so much for being on.
Thanks for having me. I am excited to be here.
So let's give listeners an overview of you and your business. Where are you located? How long you've been in business? Number of clients? Maybe if you have a niche, and then we'll dig in from there.
Yeah, happy to. So I am located in Sacramento, California. I've had the business open for just about 5 years, but I didn't actually start it in Sacramento. I decided to resign from my job and start the business. My wife and I were newly married. We were living in San Francisco and decided to move to Portland, Oregon. We didn't have any kids at the time, no mortgage, a lot of runway and flexibility to take some risk. So we decided we'd check out Portland, moved up there, decided to launch the firm. This was in 2014. And then fast forward a couple of years, we started having kids and realized that it was going to be important for them to be near their cousins and near the rest of our family. So about 2 years ago, we moved down from Portland here to Sacramento, and I basically opened up a second office. So I still have a little bit of a presence in Portland. I go up a couple times a year to meet with clients and so forth, but we reside here in Sacramento, and that's predominantly where I'm building the business.
So where's the business at in terms of clients, and do you have any type of niche market?
I didn't have much of a niche when I started. So I'll give you the background of how I came about all this. I started my career at Charles Schwab on their securities lending trading desk after business school in 2007. So for those of you who maybe have not heard of securities lending, well, I'm guessing a lot of your listeners have recently, because there's this drive to zero fee index funds, and largely that is driven by revenue from securities lending activities in these funds that they're offering now. Basically, there's this big market where if you want to sell a stock short, you need to be able to borrow it from your brokerage firm first. And so if you're a large prime brokerage like JP Morgan or Goldman Sachs that's working with some of the biggest hedge funds in the world, those funds want to borrow a lot more shares to sell short than you have available in your own inventory. So there's this big market that kind of happens behind the scenes of borrowing and lending between firms for profit and to drive settlement and client trades. So your big borrowers of the world are all the prime brokers. Your big lenders of the world are pension funds and mutual funds and ETFs, and your firms like Schwab, Fidelity, TD Ameritrade that have a lot of inventory that doesn't get used by their own clients. If you think of like Schwab's client composition. They have a couple million accounts, but most of them are more long-term buy and hold type investors. So basically, I got hired to be a trader on their desk, and my job was to lend out shares from Schwab's inventory to other prime brokers for profit to the firm. So if you think of what was going on in the world at the time, I got hired in September of 2007. Jokingly, most people I think who started in the industry at that time had a pretty rough first couple of years of their career. Throughout the financial crisis, there were a lot of hard landings and consolidations, and it was just a really traumatic period. Just by happenstance and sheer luck, I landed in the one area that really benefited from all that. If you think of the short selling volume throughout the financial crisis, the volumes on our desk were astronomical. It was really a fortuitous place to be at the time. When I got hired, it was in Denver, Colorado. I went to business school in upstate New York.
So was this your first job out of college?
This is my first job out of college. Yeah, I went to college at Ithaca College in Ithaca, New York, and then I went straight through and went right back to business school without going to work first, which was kind of, it was an okay deal. I don't know if I would do it that way in retrospect if I had to do it over. But I got out of business school, moved to Colorado and took this job. Fast forward a couple of years, dust started to settle from the financial crisis, and they moved me to San Francisco, where the firm is headquartered, and consolidated the operation a little bit. So I was there at Schwab for a total of 7 years, and it was a wonderful place to cut my teeth and learn the industry. If you think of all the stuff that goes on behind the scenes in the settlements world, and being in a place where you have a front row seat for all the short selling activity of the biggest hedge funds in the world, it was really a cool place to see what the managers were doing and why and when throughout that crisis. So, I was there for 5 years before I started to realize, I think, a lot of the same things that the XYPN network has observed. And that's that, there are more or less 300,000 financial advisors across the industry, but most of them are by and large set up to offer investment management first. And the vast majority of those 300,000 have a lot of conflicts in their service models, which I know you're incredibly fond of, Alan.
Of course. I do love conflicts of interest.
Yeah. So my thought was, of the advisors out there that are offering a really good objective service as a fiduciary in the fee-only world, predominantly most of those people are focusing on investment management and have a minimum of $500,000 or $1 million. And so my theory, and this is back in 2014, was that I could build a really nice practice and a really nice business by offering a similar service to people that have less than that amount, right? And that's not unique. There are a lot of people that came to that same conclusion. So I resigned in 2014 to start the firm, Three Oaks Capital Management, in Portland. So I didn't really start with a niche. My thought initially was that I would compete with firms like your Edward Jones and independent broker dealers who are servicing clients of that size, but not really focusing on planning, are not really trained in portfolio management per se. And I thought that the experience I had at Schwab was kind of unique. I also went through the CFA program and obtained my charter in 2011. So I thought that was a pretty compelling value proposition. So I got started in 2014. The first 18 months or so were pretty rough. I had not worked with retail clients in this capacity at that point in my career. I didn't really know how to market. I didn't have a niche, and I wasn't overly focused on planning. I was more focused on investment management. So I picked up probably 12 or 15, I don't have the numbers in front of me, but maybe 12 or 15 clients in the first 18 months that I was open. But I started to figure out pretty quickly that people in that demographic, and at least those that I was talking to, were more focused on getting the most out of their resources that they could in a planning sense. So they care about retiring on time. They care about sending their kids to college. All the things that we talk about in a planning context was kind of new to me at the time. So I grinded it out for the first couple of years, but once I realized that was an issue and went back and obtained my CFP, the pace picked up pretty quickly. So at this point, most of my clients, I have about 55 clients. I am right around $250,000 in recurring annual revenue. Most of them fit one of two buckets. I work with a lot of people in the medical profession. So physicians, nurses, dentists, orthodontists, a few vets, and business owners. And a lot of my clients fit both of those categories. People that own their dental practice and are trying to figure out the business aspect as much as being a practitioner in their field. And they're trying to figure out how they can build the value of their business and grow their own net worth while minimizing tax liabilities and maybe putting something aside in a qualified plan that's not directly related to their business. So that's pretty much the composition of my practice now. But as I say, it's gone through a lot of permutations. It was a learning experience to get here.
Awesome. Well, thank you for the background. That really sets the stage for how you got where you are. I'm curious to hear about, you're on the institutional trading desk side, which isn't even really investment management, right? Like you're not even learning, it's not like you were I guess even trading stocks necessarily or do investment management. So to go and start doing financial planning, that's a big leap. Even just doing investment management for these clients. What gave you the confidence and the courage to feel like, yes, I can do better than what some of these other folks are doing if it wasn't because you were doing planning and it was really focused around the investments? I guess what gave you the courage to make that leap?
I felt really comfortable with the investment management process. A large part of that was by virtue of going through the CFA program. And when I surveyed my competition, it was largely, people who are working at places like Edward Jones and are great people and have a fair amount of training, but that training is on, how to knock on 1,000 doors a week or whatever the numbers are. And they're not in, the substance behind putting together a portfolio that's going to get you wherever it is that you want to go with a minimum amount of risk. My comfort level with that process, I think, was a large part of it. I've always been kind of an entrepreneurial guy, always wanted to take a risk. And at this time in my life, like I say, my wife and I were newly married, no mortgage yet, no kids, had a nice, little cash runway to work with. And if I fell flat on my face, I was comfortable with that from the outset because it was something that I'd always wanted to do. So I think those were the main factors. But on top of that, the job taught me a lot too. I mean, the department I was in was within the corporate treasury, and we sat, in the same area where the portfolio managers for Schwab Bank sat, and we were in a lot of the same meetings. I had a lot of exposure to how all that went for large institutional portfolios, and that gave me a lot of confidence too.
So when did you get your CFA? What time of your career path was that?
I started studying for it as soon as I got hired at Schwab. So the cycle, there are 3 levels. The first level is given twice a year in June and again in December, I think is the second one. Second 2 levels are only given in June. So I got hired in September and I started studying for the following June exam in January, I think, of that year. So I took the first level, passed it. I signed up to take level 2 the following year in January. And when you sign up for it, you're basically, if you want a good shot at passing, you have to devote the next 5 or 6 months to hammering it pretty hard. At about 6 weeks after I signed up, Schwab approached me and said that they were consolidating our operation. And if I wanted to continue my job, it was now going to be in San Francisco, but they were going to give me a promotion and, management track and so on and so forth. So I basically had to take a 6 or 8 week chunk out of my studying that first time I took level 2 to go find an apartment and move and pack up and all that stuff. So long story short, I failed level 2 the first time I took it. I had to retake it the following year. And then the year after that, I took level 3 and passed. And so all told, I started in 2008 and got the charter in 2011.
Yeah, pretty common to fail at least one, if not multiple sections of the CFA. I think a pretty small percentage of people make it through all 3 sections without something happening in their life. So tell me about the difference, because I signed up for level 1 CFA and then never took it because it was just so economics and finance and stock based that I just could not bring myself to do it and just couldn't get motivated around it. But how do you view the difference between the CFA and the CFP? Because we get hammered sometimes on the fact that we only allow CFPs to be on our Find an Advisor portal, and a CFA will say, well, my training is more in depth in terms of wealth management than a CFP, so you should allow CFAs. What do you think about that and just the difference between those 2 curriculum and the test and overall experience? And the difference between those two designations that you have?
Just my personal opinion, I think that you and the network's decision to come to that conclusion is probably the right one based on my understanding of what you're trying to build. After having gone through both, I started the CFA at the very beginning of my career. So a lot of the stuff I was learning in the textbooks, I had not experienced at all in, real life. And so it was all fresh and new and very, very challenging. I don't buy that argument that because I'm a CFA, I know everything there is to know about financial planning. So, for example, when I went back to take the CFP, I had to learn a lot of stuff on the insurance and estate planning and tax side. The CFA doesn't cover any of that hardly at all. It covers some tax stuff from a portfolio management standpoint, but a lot of the, like I say, insurance, estate planning, and tax were brand new to me. The investment stuff I didn't crack a book for when I studied for the CFP, but I think the material is substantially different. Level of difficulty, CFA is I thought far more difficult. But again, when I took the CFP, I had already gone through the CFA and I had been in the industry for quite a while at that point, maybe 8 or 10 years. And so a lot of the stuff was easier to learn because I'd been around it in my working life too. So they're quite a bit different, but the CFA is far more difficult, I found.
Yeah, that makes sense. And it's just much more in-depth on a single topic versus being a little more broad-based. Yeah, and my response is generally if the CFA, if you learned everything and more that you need to know for the CFP and the CFA, then just go sit for the CFP. You can challenge and bypass the educational requirement. Just go past the CFP and have the designation. You'll be fine. Obviously, it's not that easy, but that's sort of the point. So you mentioned that you've gone through some different iterations in the business model. So talk to me about, you've now had several years, 5 years now of testing, or 4 years of testing and iterating. So when you first started out, it sounds like you were very much investment centric, but what was your sort of fee model and service model when you first launched? So that first dozen clients in those 18 months, sort of what was the service model you were offering them?
It was strictly AUM. And my thought at the time is that was the best way to deliver the service. AUM is, even if you're doing financial planning, it's a very serviceable fee model. I didn't have a financial planning fee offering at all. I think I had hourly on my ADV, but I never entertained that. It was solely trying to manage people's accounts. Like I say, about 18 months into it, I figured out what was, more important to people and began by offering a flat project-based fee for financial planning. So I'd have like a 3-meeting process consisted of 3 90-minute meetings with clients. And I'd charge them somewhere between, I think, $1,200 to maybe $3,500 at the outset was the range based on complexity. So I did that for a little while. And what I started to realize is that it was hard to convert people that did one-time projects into ongoing clients for a variety of reasons. And that's when I started to offer a retainer model. And I offer monthly and quarterly, but it's basically based on an annual financial planning fee that depends on the complexity of the client. And they can pay it quarterly or monthly purely based on preference. And that's what I do now. So I have a flat annual planning fee that everybody gets quoted when we begin an engagement. And if they would like me to manage their funds once we get the comprehensive plan in place, that's great, but it's not mandatory. And it's opened the door for clients that like to have their stuff over at Vanguard and like managing accounts themselves. There are a number of reasons people decide not to go that route, and that's fine. But it's been a much better model. It's still evolving quite a bit. I don't have a lot of people who have a complexity-based model in the network will have a number of factors and maybe like a hard and fast calculation or spreadsheet to actually determine what the annual fee is. My method is a little bit more subjective. I found that it's really hard to boil complexity down to quantitative metrics. It's more based on how much time is it going to take me to build the plan and work with people. But the range today is usually $5,000 to $10,000 a year for that ongoing planning.
So, yes, difficult to take that and put it into a formula, but something's going on in your head to make some of those decisions. So what are the factors? I know the obvious ones, right? Like net worth and income, or number of kids, or number of, or I should say married, or have, or with a partner versus not, real estate, business. Like, are there any other ones that you found that are sort of off the wall that you're like, wow, that really should have been considered because this thing is like way more complicated than I realized, and sort of undercut it, or I thought it was going to be this complicated, but it really wasn't?
Yeah, exactly. The very first things I look at are your standard variables: number of incomes, number of accounts in the household, number of benefits, company benefits programs we need to sort through, tax bracket, things of that nature. The reason I like to keep it subjective is because since I work with a lot of business owners at this point, the level of complexity business to business varies widely. And it's easy to underquote or overquote if you have somebody who appears to be pretty, straightforward with their planning, but then they come in and you start looking under the hood of what they have going on in the business, and there's a lot of stuff that you didn't anticipate at the outset. So that's why I prefer to keep it somewhat subjective. But it's the sticky situations are almost exclusively a result of complicated privately held businesses.
Yeah, that is its own complication. So how do you price a business? Is it, revenue of the business, or is there one, or is it just sort of like, hey, a business is an extra $5,000?
I haven't gotten there yet. Like I say, it's pretty subjective. Where I'm going next and where I would like to take it is having a more formal business planning module, maybe as an add-on to the financial plan, where we can better quote the price, number one, but also really spend a lot of time focusing on building enterprise value of whatever that entity is. And the way that I'm viewing it now is, for people that own businesses, it ends up being a substantial part of their net worth. And if my objective as a planner is to help people do the very best that they can with their resources, help them achieve their ideal vision of their future, whatever that means to them, right? Pretty vague and pretty common across planners in the industry, I think. But when you call the shots in the business, there are a lot of levers that you can pull that are unavailable to, a W-2 employee. And the value of the business comprises a very substantial portion of your net worth. And if I can help them build the value of their business by, a few percentage points a year, that's going to impact them in a far, far greater way than prudently managing their investment portfolio, right? So that's the way I'm viewing it now. I don't know what the right mechanism is to price that, and like I say, I haven't built a process to really govern that and deliver the service yet. But that's kind of the direction I'm headed.
Okay. Yeah, I found, working with business owners, it was just so impossible, particularly if the client is a small business owner. It was so impossible to try to separate the business from the person and, only plan their personal finances without looking at the business. But it does add it's basically a second client, right? Because it's all the complexity that comes with having that business. So always interesting to hear how advisors are coming up with fees and what they're finding works and doesn't work. Because in the end, like, you've got a formula in your head. We just have to get it out of your head and document it, right? And then see if it works, or if it doesn't work. And when it doesn't work, update the formula, kind of thing.
Right.
So you mentioned the move, when you started in Oregon, you start the business there, and then, you relocated down to Sacramento, something listeners are probably aware that I did as well, going from Wisconsin out here to Montana. How did you communicate that change and that transition to your clients on why it was necessary, why you wanted to do it, and sort of what was the overall reception?
In retrospect, it went a lot smoother than I thought it might have gone. When we decided to move and I started preparing for it, I was thinking worst case scenario, maybe I lose 50% or more of the clients that I had at the time, and how do we work with that, financially in our household and so forth. I didn't lose a single client as a result of the move. And the way that I positioned it with them is, I was just completely transparent. Look, as you know, we have a kid at home now. We're going to have more kids, and it's really important for us to be near their cousins and our family, both for support purposes, but because that's the environment we want to raise our kids in. So we are going to be moving physically down to Sacramento. At that point, I had I think 16 to 20 clients there in Portland, which basically allows me to go back up twice a year and cram them all into one really intense week of meetings.
Sounds like a really fun week.
It's a hell week for sure, but it's just about the max number of people that I can service up there by myself. And the way I positioned it was look, right now we're meeting more or less twice a year, and then we talk on the phone a couple times. That's going to continue. I'm going to come up here a couple times a year to see you, and our meeting schedule is not going to deviate at all, and we're going to continue doing everything in person, and I'll continue to be available to you through video conference and over the phone when and where you need it. So the business isn't changing at all. I'm just going to be sleeping, elsewhere. Unilaterally, clients were okay with that. Nobody had a problem at all, and I think a lot of it was, I'd built up a little bit of trust. I've been working with most of them for a couple of years, and I was just totally transparent.
Yeah, that was my experience as well, was just being honest and open about, hey, this is why and what I want to do, and just doing it. And I didn't lose any clients either in that transition. And like I said, you can always go back and have some of those meetings. Are you finding that clients up there still want to meet with you in person and you need that intense week? Or are you finding that, they're okay with some virtual meetings and maybe you only meet with them once a year or once every 2 years?
Probably 50-50. I think most of them still want to get together in person just because they like the support and they like meeting that frequently. There are a handful of clients, the other 50%, a lot of times they don't need that at all. And so we'll have a meeting on the calendar, and the day of, there's maybe like a lot of traffic that day and it's inconvenient for them to come down to the office, and they'll say, hey, can we just meet over video conference instead? And that's fine too. It's a little bit frustrating because I carve out the whole week to see people in person, but their clients are comfortable with that. And by and large, I think at this point, everybody is totally comfortable with the engagement. And I don't think I have a single client who's not had at least one video conference too. So there's not the burden of or fear of wondering, what is it actually going to be like if we have to resort to video conference as opposed to meeting face to face? So everybody's pretty comfortable with it at this point.
So where are you finding success in terms of gaining clients? Because it sounds like you've had pretty steady growth year over year at this point from a client perspective and a revenue perspective to be where you are today. So what are you finding is working in terms of client acquisition, and how has that changed, before you were doing financial planning and then after, since you had such a big pop there from getting your CFP?
You know what? I would say that I've had pretty steady growth. When I transitioned from doing the one-time financial plans to not offering that anymore and only doing ongoing engagements, I took a step back, and not in revenue, but in number of clients that I was working with. I think the year so after I got my CFP, when I was doing one-time financial plans, I think I did a total of like 50 or more one-time financial plans, and not very many of those clients continued working together afterward. So the following year, I dropped that and only entertained the ongoing engagement. The growth took a big step back too, and maybe it was just by virtue of the number or the specific people I was talking with, but it seemed like a lot of people were only looking for one-time project work. And once I turned that off, the growth took a little bit of a step back. Today, the source of most of my new clients is some kind of online activity. I have a nice email list that I've built up over the years. I've not always been good about reaching out to the people on that list very consistently, but now I've had the opportunity to hire a little bit of help, clear out my calendar to consistently blog. And at this point, I put out a blog post every week. I email my list every single week, and I offer a webinar every single month. A contractor who works at Google that helps me with advertising those events. And most of my new clients come through those channels. So maybe it's like a NAPFA inquiry or a fee-only network inquiry. They go over to my website. We retarget people who visit my website with webinar offers, and eventually they get added to the list, and I drip on them over time, and those people eventually schedule a meeting, and some of them don't. But that's the majority of the people that are coming through and the people that I'm having an opportunity to meet with.
All right, there's a couple really interesting things there. So the webinars. So what types of topics are you doing on a monthly basis? Is it the same topic over and over, or are they different each time?
I try to do it different each time. And at first, it's kind of a guess and test of what topics do I think my target market might be interested in? But after having a little bit of engagement and people responding to emails and reaching out and having conversations with enough people, there's kind of a consistent set of topics that people are asking about. And so that's where I get my topic ideas. And the way that I have it set up now is every month I create, I do a new live webinar on a new topic, but I record it and offer it as an evergreen lead magnet from that point on. So for example, I've got one coming up this Tuesday. It's going to be on international investing and whether or not investing in the S&P 500 alone gives you a sufficient amount of international exposure. We'll record that, and then I'll continue driving traffic to the recording with a call to action at the end of scheduling an appointment. And that the call to action differs a little bit webinar to webinar, but that's how it's set up. And it's a nice way to build the library, if you will, of content and have evergreen lead magnets that more and more people will subscribe to over time.
So, do you know what your contractor is doing in terms of advertising? Is it paid ads? Is it primarily social media, or is it on Google? Like, where are they getting eyeballs on these ads to drive to the webinar?
We begin trying with Google ads, and we would pay for some search terms. We would retarget website visitors on the Google Display Network, and we would do YouTube ads as well. So I have like promotional videos promoting each monthly webinar that we would advertise on YouTube to people here locally who might fit the demographic who would be interested in. Those activities didn't work so well outside of the retargeting on the Google Display Network. And I think the reason was people who you're retargeting have already visited your website. They're somewhat familiar with you, and the cost to retarget people who've already visited your site is really low. Because I think for most independent financial planners, we're not getting millions of visitors every month. It doesn't cost very much to put ads in front of the audience who's already been to your site. Today, where we're putting most of the effort is in Facebook. It just seems like we're getting better conversion rates, and we're able to, I think, more granularly target the right type of person to put the ad in front of. And the cost per conversion is significantly lower.
Yeah, so just for listeners' benefit, you may already know all of this, but yeah, retargeting ads are when you can run paid ads. Someone goes to Google, they type in, looking for a financial planner. Those top three are an ad, basically, that you pay. Those are extremely expensive. Anything with the word finance can be $50 to $100 a click. So the moment someone clicks it, whether they become a client or not, you pay $50 to $100. What you're referencing are retargeting ads, which is basically when someone comes to your website, you pixel them is what they call it, but you track them. And as they float around the internet, you float around with them, and your ads are shown in front of them. So you're getting people who have already been to the site and simply showing those people an ad, which to your point is pennies on the dollar compared to some of those retargeting. So do you mind if I ask what your monthly budget is on this ad spend, and maybe what part of that is contractor fee versus just like strict ad budget?
Yeah. So I pay the contractor $400 a month to do this. And our ad spend right now is about $200 a month. So the majority of the cost is paying him to do it. But the long-term value of acquiring a client is high enough easily. I mean, it's multiples and multiples of the cost to acquire it through those means.
Yeah, I mean, most folks, if you're charging $5,000 to $10,000 a year, then a client acquisition cost of $5,000 to $10,000 would be appropriate for many platforms out there. Like an 80 to 100%, first year fee is pretty normal in like the tech world. So that's pretty incredible, and that doesn't even include the fact that your retention rates are way higher than the tech companies for their technology. So have you seen conversions yet, or I mean? Well, let me just ask that. So on the front end, you're spending $200 a month. How many webinar attendees are you seeing in general?
I get between 20 and 30 a month. I usually get a couple meetings out of it, and I'll get usually a client a month, but if not that, every other month from that funnel.
All right. Well, hopefully your Google consultant is ready to go full time, because I've got a job for him. That's huge. I mean, those are conversion numbers that's incredible to be able to get that many people in. You're getting one client every month or two. I mean, you're talking about, 60,000. I'm backing out math. 80 to 90,000 in revenue for the year on, potentially if that continues going forward, and you're spending, $5,000-6,000. That's an incredible ad spend. You should dump $1 million into that program. Obviously, you can only bump it up so high. Have you tried bumping it up just to see if it increases? Like, can you go from 20 to 40 if you double the ad spend, or are you finding that sort of a saturation point?
We haven't tested that yet. And I should caveat all this. I mean, it's easy to look at, cost per conversion, cost per meeting, cost per client and say, holy smokes, the ROI on that is fantastic. Let's go to the bank and borrow, a ton of money right now. I would say that a substantial portion of those 25 attendees are people who have been on my list for a while and now maybe all of a sudden are interested in the topic this month and maybe have never reached out before. So they're already pretty warm prospects. And, after having a list that I've been building for, 5 years, I don't have a tremendously large number of people, but they've heard from me for a while. So I've developed a little bit of trust. And figuring out what webinar attendees are coming from that list and how long they may have been on the list, and parsing that out against people that are coming through a Facebook ad to a new audience that my Google guy just put in front of them 2 weeks ago is really difficult. We haven't figured that part out yet. So we're not dumping a bunch of money into it yet. We're slowly, starting small and then slowly growing it to make sure that I don't waste a whole lot of funds.
Okay, that's totally fair. That the data analytics side of this is going to be important. That do you start putting $1,000 a month into that because it increases conversion, or does that simply increase the number of people on the list, and it's still going to take 3 to 5 years for those folks to convert? That'll be really interesting to track. But it is interesting, even without the ad spend, just the webinars that are working in terms of converting for your existing list, which is really cool. So did the idea of the webinars come from somewhere? Was it requested by clients or prospects, or see it working somewhere else?
I took Jeff Rose's blogging course a couple of years ago. I forget exactly what he called it. It may have been Online Advisor Growth Formula or something like that. And he used webinars in his practice with his blog, Good Financial Sense, to a lot of success. And if you think of all of our marketing efforts as advisors in terms of the good old marketing funnel, where somebody totally cold comes into the top of the funnel by visiting your website, and then the objective is to convert them into a subscriber to your list, and then continue moving them down the funnel with larger and larger asks over time. That's kind of the idea, and so the webinar for me was a really nice complement and addition to that marketing funnel by having kind of like a medium funnel ask of leads and prospective clients. Maybe they've been reading the blog for a while, maybe they've been signed up to the email list, but they've not had a reason to reach out and engage. This is a nice low pressure way to say, hey, I've got another topic I'd like to talk about in a live setting. I'm going to open it up to, Q&A at the end. Why don't you come in and join us? And then I'll have a call to action to schedule a one-on-one meeting at the end of that event. So that's kind of how I came to it. But the idea of adding, the more and more I can free up my time and add more things to complement the marketing funnel, the stronger the whole system's going to be. And so I've had enough success with webinars that I'm going to continue, but the next edition, might be a podcast or a video series or something else that kind of fits with everything else we're trying to do.
It is one of the challenging things about sales and marketing is just figuring out what's working. Whenever you have so many of these pieces that are linked, it's not like you can, if someone out there is just starting their business cold and has never done any marketing, just starts posting some ads to a webinar, that may or may not actually have any effect, right? When it's paired with a newsletter and a podcast, and you're going out meeting centers of influence, and people that have had meetings with you refer their friend to your newsletter, like all of these things are connected. And I do know, as planners, we hear this a lot with marketing, like how many times do I have to tweet to get a client? It's like, well, it's just not how it works, because when they see you on Twitter, that's when they come to your website. That's when they get hit with a retargeting ad. They show up to 3 webinars, you drip on them for 6 months, then they schedule a meeting. And that is a more typical online funnel, and just overall management of that can be a bit daunting for folks who haven't done that before. So you mentioned just a few minutes ago that you had hired. So what does your current team look like in terms of full-time folks as well as contractors?
Yeah. So at the end of last year, I got to the point where I had, I think, maybe 40, 42 ongoing clients, something like that. And it was just me. And I was busy enough that I was starting to pull my hair out and really struggling to keep up with the production of new content to kind of to drive new clients and so forth. So my first choice, or the first thing that I tried at least, was a virtual assistant. So I went with a virtual paraplanner, Dan Kellerman's company, and I had really good success with that. I really liked the person I was paired with. They came in, I paid them an hourly rate to help me with some of the marketing things I was doing, to fill out forms. My custody at Schwab, so I gave her access to the institutional center there and had her draft forms for me for clients. And it was a huge help. A couple months later, I had a meeting with a prospective client. It was a young woman and her brother, and they came in and they had inherited some money from their grandfather. They weren't really sure what to do with. It was not a terribly large amount of money, and they weren't very good clients for, they weren't a good fit for the practice at that point. But I really liked her brother. He was a guy who came out of the Navy just recently. He'd spent 8 years in the service. He's really interested in finance. He's going back to get his undergrad degree. And so I invited him to be an intern for a period of 60 days. And my thought was that if at the end of that 60 days, he's competent and a good fit and is interested in continuing working together, I'll try to train him up and get rid of the virtual paraplanner in favor of having him be here in person. And my thought was that, probably at the end of this year or the end of 2019, I will need to hire somebody full-time as an office administrator. And there's going to be a pretty stark jump between having a virtual paraplanner on an hourly basis and training up somebody brand new, fresh in the seat as a full-time associate. And so I went through this process with Ryan, and the idea is that I can continue training him, building his hours. It's a really good fit so far. He's doing a great job for me, and he can grow with the role as the work evolves and thickens. So rather than having to hire somebody full-time and train them up from scratch, he can grow and we can build his hours eventually and grow into a full-time role when we get there. And that was a really good decision. So at this point, I canceled the virtual paraplanner because this is a better fit. I have Ryan, and then I have Brian, who is my person that does the Google advertising. So it's just the three of us at this point.
Ryan and Brian, I like it. That probably makes it really confusing. What is, we talked a little bit about your fee structure and sort of what you're doing there. Talk to me about the service model and maybe some changes that you've experienced there and what you've learned is working for you. When you look at, new client comes in, they're getting services. What does your service model look like currently and how has that evolved?
Sure. The current model is the very first thing that we do is draw up the comprehensive plan. I mean, it's probably pretty common across network members at least. But what I do is I split it up into 3 90-minute meetings. New client comes in. When they decide to be a client, we sign an agreement, and then I ask them to go gather all their data. So I use Precise FP for that, which has been a pretty good fit. And I use eMoney for planning. So I sync up the Precise FP data to eMoney. Once they have all their stuff in place and they've filled out my fact-finding onboarding form, we get together for the first of these 3 90-minute meetings. My thought, and what's worked well recently and what I do currently, is we split that first meeting up into 2 halves. And in the first half, in the first 45 minutes, we just talk about them. We talk about where they're from and what money was like growing up and some of those financial life planning questions. What would you do if you won the lottery? What do you do if you have 12 months to live? What do you do if you only have 2 weeks to live? And just really get a sense for who they are, how did we get to where we are today, and then on a forward-looking basis, what's going on right now? What's going on in the next 12 months, next 5 years and longer? And what do you really want and need from your resources to be happy and content? I try to communicate that that's the lens through which we do everything from a financial perspective, right? We want to know what's important to them and what they're trying to accomplish so that we know what pieces to move around financially. So once we're comfortable with that, and it takes up about 45 minutes or so, we pivot and we start going through the form that they fill out for me. So the data gathering form, I bring it up on the screen in person or on video conference if they're remote. And we just go through it piece by piece. And I ask them, a ton of questions about their stuff, and we try to fill in all the blanks. So at that point, at the very end of the first meeting, I give them a quick demo of eMoney and ask them to link all their accounts prior to our second meeting. And what I do before that second meeting is I download all the bank and credit card transactions for the last several months and build that into basically a household P&L over that time period. So of the six, 7, or 8 different sections that would usually comprise a comprehensive financial plan, what I like to do is we meet the second time and we always start with cash flow. So work through all the income coming into the household. Where is it going in terms of expenses? How much are we saving? How much are we paying and putting toward taxes? And how much is the difference contributing to your net worth if you're cash flow positive, or taking away from it if you're cash flow negative? At that point,
really quick.
Yeah, go ahead.
Budgeting. Do you have a tool that you're using for this? I mean, you're downloading transactions and categorizing. Is there a tool, or are you doing that manually?
I do it mostly manually, but I have a spreadsheet template that I use. And eMoney does a decent job at categorizing transactions that come in anyway. So Ryan and I don't have to spend a whole lot of time going in there and recategorizing things that have come through eMoney's link.
Okay. Yeah, I haven't heard the best things about any of the budgeting. They're all basic budgeting tools. It never really provides the flexibility you need to do it on your own. But that's also a pretty time-consuming process when you're doing it manually. So are you finding a good ROI in terms of the client experience for the amount of time you're spending on that?
I am, just because I think a lot of clients that come in a lot of them own S corporations. And one thing I hear all the time is that, I feel like we're doing well, the business is growing, but I have no idea how much money we're actually making. We're taking a nominal amount out of the business in the form of W-2 wages, but then there's all this other money left over and we don't know what to do with it. And so spending a lot of time on that cash flow management and how much do you keep in the corporate account? How much do you send over to your personal account? And what are we doing with those savings? Should we reinvest it in the business? That's a really frontal lobe, high priority item for them. So that's why I like to spend a lot of time on it.
Sorry. So yeah, I interrupted you, but I was just curious about the cash flow side, because I know that's something that most advisors will agree that cash flow is so critical and important, and yet really don't have good tools to be able to address it with our clients. So once you're done with that piece of the process, where do you go next?
Yeah, I mean, it's like everything, it's kind of evolving. It's not perfect, but it works for me at this point. So I like to work through the other sections of the comprehensive plan in order of priority for them after we tackle cash flow. And so if it's something going on in the business, we'll talk about that next. If it's starting a 529 for their kids, we'll talk about education planning. If it's retirement planning or qualified plan management, we'll tackle that. And I always like to at least touch on all the other main sections of a financial plan. So insurance and risk management, your tax planning, investment planning, retirement, and estate planning. But it's somewhat customized based on the client's needs. I'll also add that WealthBox, so I use WealthBox as my CRM, and I have a process flow for each step in the planning process that Ryan and I use to govern all this stuff. They've come a long way in the last 24 months since I've been using the program in terms of their process flows, and it allows for enough customization where that can actually work when you're dealing with a fair number of clients. Otherwise, it would be a heck of a lot of work.
Yeah, like I said, it's just the beauty of systematizing, right? And as you hire, being able to hand off some of those steps to a paraplanner or an associate is huge. Once you're done with the financial planning process and you go through and you outline the plan, you outline the recommendations, what does the ongoing service look like? How often are you meeting and sort of what are you finding you're doing in those meetings? Does it end up just sort of coming back to investment returns, or are you do you have a more proactive, structured process for how you're handling those?
It's a little bit more proactive. Generally, the construction of that plan at the very beginning of the engagement, so three meetings, sometimes that spills into 4, we'll usually get it done in about a quarter. What I like to do for the rest of the first year is, so we spend these 3 or 4 meetings building the plan. Part of that output is a list of prioritized action items to go execute the plan, right? The plan's not going to really do us any good if we don't put it into play. And so for the rest of the first year, I like to meet quarterly to work through that execution plan together and make sure that it's in place by the end of the first year that we're working together. Again, everything's customized. Some people don't need to meet that frequently, but that usually covers the first year of the engagement. After that, I like to get together at least twice a year. Usually it'll spill into 3 meetings a year, and basically update the plan and make sure that we're continuing to make good financial decisions relative to everything that's going on in their lives. And when I first started doing that a couple of years ago, I thought it might be too maybe unnecessary to redo the financial plan every single year. But what I'm finding is that at least the demographic of my clients, enough stuff is changing on an annual basis that it makes a lot of sense to just chop the financial plan in half. And in Q1, Q2, when we get together, cover estate planning, cash flow, and investment planning. And then in Q3, Q4, cover insurance planning because that coincides with open enrollment if you do it early enough in the quarter. Tax planning because we have enough data to do a decent projection for the year and enough time to make changes if that's necessary. So that's worked for me so far, but like I say, sometimes it'll spill into a third meeting throughout the year depending on what's going on with the client and if they need to get together for some additional time.
Yeah, I was going to ask that sort of what dictates that third meeting. So it sounds like life circumstances is really the answer there.
Yeah, exactly. Generally, it's twice a year structured, maybe a third that's less structured.
Michael does a presentation and he talks about the meeting to determine if you need a meeting. And when we meet quarterly with our clients, it's really we use that meeting as a way to find out if we even needed that meeting in the first place. I like your structure of like, hey, we do 2 structured meetings, but we can add a third or even a fourth if you need, as opposed to, hey, we meet quarterly and half of them get canceled because there's nothing to talk about or they're just a waste of time.
Clients definitely appreciate when there's a set agenda. And what I try to do is schedule the next meeting during our current meeting. So every 6 months, or when we meet, we're already getting the next meeting on the calendar 6 months out, and just covering what the agenda of that meeting is going to be. And then when 2 weeks prior to the meeting, when I confirm it with them via email or over the phone, I just say something like, this is the loose agenda I have for this upcoming meeting. Is there anything going on that you'd like to prioritize, or are there any changes you'd like to make to that agenda? And it really helps with engagement. People really are fired up in general about coming in and having these meetings because there's a firm agenda and we're not meeting so frequently that it's unnecessary.
All right, fair enough. If you've really grown the business, I mean, you're in a really great spot. You're through the, oh crap, what did I do phase that I like to talk about of entrepreneurship, where, you're now at a place where you're making money, maybe, net wise, you're actually making more than you were at Schwab. But you're starting to build a team. But looking forward, and now you're in this position where you get to pick, you get to decide what you want the business to be when it grows up. What is your vision for the business? Is this going to be a huge business, a small business? Is it just going to be you and you never end up with anybody else full time? Sort of, what's your vision for what the business can be for for you and your family?
At this point, I think I would like to grow a really large business. I say I think because I understand that I'm probably really naive with regard to some of the complexities that larger firms have to deal with and some of the growth barriers that are really challenging at various stages of the life cycle. But I really enjoy a team environment. I played sports growing up. I played baseball in college. I worked on a really good team when I was at Schwab, and I really like that environment where there's a lot of people who are pulling for the same thing and helping each other reach a common objective. And so the vision today is to build this thing into a large firm. I'm trending more and more toward working with business owners. And like I was saying earlier, if I can find a way to build a process that helps business owners do the best with their primary asset, which is the equity that they have in their business, I think that there's a ton of opportunity there, alongside the fact that I really enjoy the process of building the business. I mean, I really like working with people. I really like the industry, and I can see myself doing it for a long time. So I think the trajectory will be toward building an enterprise level firm, but I'm kind of hedging that because I don't fully appreciate all those growth barriers that pop up along the way.
Yeah, I love this discussion because I've had people tell me like, oh, Alan, I don't want to be the CEO of a 20-person company or a 50-person company. I'm like, what do you think life's like as the CEO of a 20-person company or 50-person company? Because I didn't think I wanted that either. And here we are. I think we've got 40, we're pushing 45 team members here at XY. And then if you include advice pay, it's somewhere around 55 people. And biggest company I ever worked for had 5 people. So, I mean, I had no idea. And the truth is the challenges don't get more complicated. They just evolve. They just change. And instead of dealing with, process improvements for your client or trying to become better inside of a client meeting, you just become better at management. You become better at hiring or whatever the thing is. So I always encourage folks, don't let it be scary to grow. It's more about what you want to be doing day to day. Like you said, if you're enjoying growing the business and running the business, I'll say that's the right answer. If it's, I love doing financial planning, but I want to grow a really big business and own it and run it. It's like, you can't be all things to all people. You're going to have to pick. And that's, I think, the challenging part of growth at times for advisors.
Right. Yeah, certainly. Is it okay if I turn that around on you and ask you the same question?
In terms of where we want XY to be?
Yeah.
Yeah, I mean, we use the EOS Entrepreneurship Operating System from the book Traction. That's sort of the toolkit that we use. There are many toolkits and they all work equally well. We just picked one and went all in with it. And so what EOS encourages is a 10-year vision. They sort of move away from the BHAG, big, hairy, audacious goal of like, where could we be in 30 years, which we've talked about in the past. So our vision, our 10-year vision is 5,000 advisors with a growing sort of platform of services for those advisors. So we have almost 1,000 now. We'll hopefully be crossing the 1,000 mark this summer. But what we see is as our advisors grow and are more successful, we can offer more services to those advisors because they're already spending money on many of these areas, and we can do it at a lower cost and more efficiently. So things like FA bean counters with our bookkeeping service, or, we're rolling out white label tax preparation service. So, we can do taxes for our advisors' clients on behalf of the advisor. So sort of a white labeled solution, XY Investment Solutions with our TAMP. And I've got about 14 more of those I'd love to roll out. Michael won't let me do them all at once, but we just continue to see as our advisors grow and they have more needs that we can continue to build out different services. Sometimes they're going to be smaller niche services, sometimes a little bit broader and that sort of thing, but serving that core membership. So that's really, that's our vision for the business.
Sure. Makes a lot of sense.
It's weird being on the other side of the question. Someone recently told me they were just like, it's so much coaching. I'm like, I know. We should just do like coaching calls where you can coach me and I can coach you for the podcast. So switching, or I guess changing that question a little bit, but along the same vein, what are you really looking at over the next 12 to 24 months that you're going to be building in the business? What are some of the bigger projects and things that are coming down the pipe for you that you're going to be focused on?
One thing I'm trying to be really conscious of right now are the consistent barriers to growth that advisory firms hit across the industry. And, Angie Herbers has her graph that you can Google and find on the internet of at various levels of revenue, advisory firms tend to run into pretty common growth barriers. So I'm trying to be conscious of what those are and not grow so aggressively fast that I'm pulling my hair out when we run into those complications. I'm spending a little bit of time just understanding what is coming down the pipe and trying to plan for consistent growth so that we can blast through those barriers without an overly, strenuous time period. And so for me, the next one that's coming up in the next 12, 24 months is I have Ryan. We're going to continue training and growing his skill set so that he can take on more and more stuff. But I would expect that we'll have a full-time associate planner on board probably around maybe January of next year, and figuring out where the right place to hire that person is, what the training involved is going to be, and how I'm going to be able to manage my time between getting them up to speed and to where they're productive and valuable and working with client load and continuing to grow the business. It's going to be quite a juggling act. So that's what I'm focused on right now is how do we get over that near-term hump in the least painful way and the most consistent way?
My advice is hyper growth, because then you have to get past it.
Different strokes for different folks.
That's it. That was sort of our experience at XY where it grew so fast early on that it was like there was no time to be the guy that did all the work and then slowly transitioned to management. It was just like, all right, like got to hire people, they got to do the work, and I got to manage. Can't say I recommend that path, but it is a path. But yeah, that will be a transition in learning how to manage if you haven't managed before, and learning what type of business you want it to be. What's the culture of the company? What are going to be the core values that you hire and fire for? And these are questions that ultimately most business owners don't ask until it's too late. And then they realize they've hired the wrong people, or they can't set their actual core values because none of their people meet those core values, because again, they hired for skill instead of for culture fit. So all fun things that'll be good learning and good exercises be going through in the coming years.
Yeah. And you mentioned the book Traction and how you've been applying that to XYPN. I've started to do some of that here too. And for those of you out there who are not familiar with it or haven't read it, definitely recommend the book. It's by, is it Gino Wickman, Alan?
Yep.
So that was really good. I got to a point in the business about 6 months ago where I had all these thoughts about all the stuff that you're talking about, core values. What is the longer term vision, and how are we going to hire and fire and build around that foundation and those ideas? But I didn't have any framework with which to view it through. That book was really, really helpful in that regard. So definitely recommend it.
Yeah, we love it. We used to follow Scaling Up, and I think we'll go back to Scaling Up at some point. It is just a lot harder to grasp. I mean, I had to read the book like 3 times before some of the concepts took hold, whereas Traction is just, it's the same stuff, same concepts, simpler language. And so, yeah, when you're solo or you just have 1 or 2 people, there's going to be some things when you go through Traction, you're like, oh, I don't need all this. And you're right. There's going to be some things that you can just sort of chill out on. But there's definitely some pieces there, start laying the foundation for, again, that when you make that first hire, you have a way of objectively evaluating, do they meet the core values? And not just like, oh, I like this person or I don't. You should be able to want to have a beer with your first team member. You should want to have all of your team members over for dinner at some point, but that's not enough. It's got to be more than that. So, wow, this hour has gone so fast. So I'll wrap up with a final question. And that is, if you could go back and tell your younger self one piece of advice, one thing that you've learned that you wish you had known then that you know now, what do you think that piece of advice would be?
I think for me, it would be just be patient with all of it. And it's a marathon, not a sprint. I looking back on how I got to the point the business is at today, it would have been a lot easier having to go to work at another financial planning firm first. I'll also say that I don't think my younger self would have listened to that advice. Like I was explaining earlier, we were just in a point in our lives where I had some runway. We had a lot of capacity to take risk, and I really wanted to go for it. And so we did, and I don't regret doing that. I would also have benefited from being a little bit more patient along the way, and understanding that it's a long-term thing that will come over time if you make a concerted and consistent effort into the business.
I love it. Well, thank you so much for taking the time to come on the show and share your career journey and your path, and wish you the best of luck in your upcoming adventures, because they're certainly going to be a fun ride.
Yeah, thanks for having me on, Alan. This is great.
XYPN Live is a financial planning conference unlike any other in the industry. At XYPN Live, you'll learn real strategies for building your firm, whether you're just getting started or you're a seasoned firm owner. Or maybe you just want to earn some CE credits, connect with other advisors, or be part of the real financial planning movement. XYPN Live offers all of that and so much more. Go to xyplanningnetwork.com/XYPN Live Radio to get your pass today. Be sure to join our VIP community at xyplanningnetwork.com/VIP to hang out with other XYPN Radio listeners, ask questions for future mailbag episodes with myself and Kitsis, and to finally find a community of like-minded financial advisors. Thanks so much for joining me today. We'll see you next time.
You're not alone, and you're not crazy. It's scary starting, building, and growing your own financial planning firm. And that's why we put together a free private community just for you, the Cutting Edge Financial Planner. Go to xyplanningnetwork.com/VIP or text XYPN Radio to 33344 and join a network of thousands ready to change the lives of Gen X and Gen Y clients.